Hello friends, a very warm welcome to my channel. In today's video, we are going to analyze a company called Shri Pushkar Chemicals and Fertilizers. It's a small cap company and it's into the dye stuff and fertilizers chemical space. The company is doing a lot of capex and it's at an inflection point of growth. The sector has been getting a lot of eyeballs lately because of the Russia-Ukraine war. So there's a lot of demand generated in India for fertilizers as well. So before we begin, if you're new to the channel, please do subscribe and hit the bell icon so that you get all the notifications of my new videos. And if you're not a part of our Telegram channel, do join right now as we discuss a lot of interesting stuff on daily basis on a Telegram channel as well. Let's get started. So Shri Pushkar as a company was established in 1993 and started manufacturing in 2001. They manufacture different products in 4 to 5 different categories like chemicals, dyes, dye intermediates, cattle feeds and fertilizers. They have more than 27 years of experience in this industry, and the company interestingly has developed a zero waste business model because they use the waste generated from one segment to produce products of some other segment. They have done some key acquisitions during their history and they were able to turn around those companies pretty well, and they have generated a lot of money in terms of profits by acquiring those companies. And the company is kind of a one-stop shop for the dye textile industry. Let's talk about the history of this company to understand in detail. They started business in 1993 as a trading concern, and in 2001 they started manufacturing, starting with the dye intermediates. Now what is dye intermediates? They are used to produce dye. They are kind of raw materials for dyes. In 2002 they did backward integration and started manufacturing some in-house raw materials which they used for dye intermediates, and in 2010 they started their own acid complex, so they further diversified in manufacturing acids. This company mainly manufactures sulfuric acid which is used for captive production in other products. In 2011 they started manufacturing super phosphate and soil conditioner, so further diversification happened, and in 2015 they got listed on the NSE and BSE. In 2016 they forward integrated the value chain to manufacture dye stuff from dye intermediates and acids. They now started manufacturing actual dyes which are used for textile industry, and in 2017 they further diversified into fertilizers portfolio, starting with a product called SOP. They also acquired a company called Kisan Phosphates Private Limited in 2017, which was a very key acquisition, and that company is doing very well as a subsidiary now. In 2018 they started their own range of dyes in the brand called Dicol. These are reactive dyes. And in 2019 they started a sulfuric acid plant, which is again a key product for this company. In 2021 they further expanded their business by acquiring another company called Madhya Bharat Phosphate Private Limited. This caters to the central Indian region for the business of phosphates, and they also started production of their AHNF new plant. In 2022 they had done further capex and expanded their capacities in unit 5. They also started a solar project. They also started manufacturing of the product GSSP with a capacity of 10,000 metric tons. Now let's talk about the management of the company. The managing director and chairman of the company is Mr. Puneet Makharia. He has 27 years of experience in this industry and he is the key person as a guiding light for the company. He has done his BCom from Mumbai University and he specializes in the industry of dyes and chemicals and fertilizers. Now let's understand the business model of the company. Broadly, the company's business can be divided into 5 segments, and these 5 segments are as follows. The first one is the dyes, the second would be the dye intermediates, the third one is the fertilizers, the acids, and the last one is the animal nutrition business which they started recently. Now let's talk about each business segment in more detail. Starting with the dyes business, they are one of the leading manufacturers of dyes for the textile industry in India. They have a capacity of 6,000 metric tons per annum, and they have a brand called Dicol, which is their own brand of reactive dyes. Their dyes are sustainable and use very less water and energy, and their dyes business is a government recognized export house of more than 15 years. The next segment which they are into is the dye intermediates. Now what is dye intermediates? They are the raw materials for producing dyes. So they started with a single product in 2001 in dye intermediates, and now they manufacture more than 10 products in the dye intermediates like H acid, VS, K acids, gamma acids and the others. So those who have technical understanding of this industry may understand it better. So all these products are manufactured based on the demand globally, and a lot of them are used by the company for captive consumption itself. Captive consumption in the sense to manufacture the other products of their industry within the company itself. And recently they expanded the capacity of this segment from 9,000 metric tons per annum to 22,000 metric tons per annum. The third segment which they are into is the acid business. In acid business, they have started this because they wanted to do a backward integration of their products. They manufacture sulfuric acid, oleum, chlorosulfonic acid. So these are the things which are widely used in the manufacture of their own products. So most of it is captively consumed and the remaining is sold outside in the market by the company. The next division which the company works in is the fertilizers business. In the fertilizers business, the company is among the top 5 manufacturers of a fertilizer called single super phosphate in India. They have more than 15 types of fertilizers which the company manufactures. A few of them are like Pushkar sulfate of potash, that is SOP. Another one is Pushkar NPK. There's another, so this fertilizer enhances the health of the plants. In the fertilizers business, they have a very wide distribution network spread across a lot of states like Haryana, Punjab, Rajasthan, Uttar Pradesh, Himachal, Uttarakhand. So a major part of the north and central Indian region and the west also. The next segment which they work in is the animal health and nutrition. Mainly this segment was formed because they wanted to use the waste generated from the other segments to manufacture some products, as they wanted to be a zero waste company. So they use the other products waste to manufacture the cattle feed supplements, and these cattle feed supplements which they manufacture, they prevent softening of the bones of the cattle as well as rickets in the cattle. So broadly these are the 5 segments of business of the company. Now let's come to the subsidiaries of the company. There are 2 key subsidiaries of the company. First one is the Kisan Phosphates Private Limited and the second one is the Madhya Bharat Phosphate Private Limited. So both of these are 100% subsidiaries of the company acquired in the last 5 years itself. So Kisan Phosphate Limited, it's again manufacturing the single super phosphate. So it is one of the largest in India. Company has strong presence in Punjab and Haryana, which are the key states of agriculture in India. So that gives this subsidiary a lot of advantage. They have their own backward integration in manufacturing sulfuric acids, and they also have their own captive power generation plant. The next subsidiary is the Madhya Pradesh Phosphate Private Limited, which is MBPPL. This also is a 100% subsidiary and acquired recently in the year FY21. And after acquiring this subsidiary, Shri Pushkar has become one of the largest in the SSP manufacturing in India. The company has a pan-India distribution. So through its own parent company as well as subsidiaries, you can see it is covering a wide range of states in India, and they are further penetrating into the other states as well. Now let's talk about the industry in which the company operates. First, let's talk about the fertilizer industry. As you know, the fertilizer industry is highly regulated. The government lot of times intervenes in between and fixes the prices of fertilizers or caps the fertilizers. It's a high capex industry where you have to spend a lot of money to establish a manufacturing plant. The next industry we are going to talk about is the chemical, specifically the dye stuff industry. So the Indian dyes and pigments industry's market is expected to grow at a CAGR of close to 11% from 2021 to 2026. So a double digit growth in the industry itself is a good number. And earlier we were import dependent in the dye stuff chemicals, and now in fact, India as a country has been starting exports. Majorly, the users of dye stuffs in India are the textile industry. Other than textiles, there are other industries like paper, plastics, etc., which also use the dyes. But textile industry accounts for almost 80% of the consumption of the dyes. Now, as India has started exporting, it accounts for almost 16% of the global exports of this industry. And there are a lot of schemes run by the government to promote this industry, like Atmanirbhar Bharat PLI schemes and 100% FDI to promote this. Now, without having a competitive edge or economic moat, you shouldn't be investing in a company. So let's understand what is the competitive edge of this company. The management is very much experienced in this industry for more than 27 years. They have a very well diversified customer base, so they don't have single customer dependency. In terms of products also, they are quite well diversified. They have their own logistics fleet, so they can deliver products timely to their customers. The company has been very successful in doing key acquisitions, and they have turned around those companies and made them very profitable. They have forward and backward integration, and it's a zero waste company. They have their own captive power plant. In terms of cash flow, they have a strong operating cash flow, and it's kind of a one-stop shop for the dye textile industry. Now, what is the growth plan of the company or strategy of the company going forward? They are doing a capex of close to 180 crores, out of which they are spending around 114 crores, which is already spent on their unit 5, and the acid plant's trial run has been started in March 2022 itself. The sulfur chemistry plant's trial run is also started. The company is giving a guidance of about 800 to 900 crores in FY23 in the earnings call recently, and the company is getting a lot of advantage of the China Plus One strategy. Their recently commenced solar power project is generating almost 5.2 megawatts of electricity for them. The company is also open for some inorganic acquisitions, and you may hear some news from the company going further in the coming months. Their new dyes and intermediates plant is also ready to start production, and they are just waiting for some approvals. And going further in terms of revenue, I've understood that 800 to 900 crores guidance is given for FY23, and the profit margins, the profit after tax margins will gradually improve, and they are giving a guidance in the long term of about 11 to 12% at the net profit level. Now let's look at the expansions, what the company has done in terms of their capacity. In the chemicals business, they have been expanded from almost 14,000 metric tons per annum to close to 21,460 metric tons per annum. So they have almost increased 50% capacity in FY23. The fertilizers capacity will go up from 4,26,200 metric tons per annum to almost 5,90,200 metric tons per annum, which is a rise of almost 38% in FY23. So you can see the capex the company is doing and the capacities of production the company is adding along with the product diversification. Now, what are the risks which this industry or this company specifically is going to face in their business? This business is kind of cyclical, as it's dependent on the monsoons. If the monsoons are good, the business is very good, or if the monsoons are bad, the business may be impacted. This business is also dependent on the import of raw materials from other countries. So availability of raw material, prices of raw material, the freight cost, all these impact the margins of the company. Within the year itself, it cannot be an even revenue. It's a seasonal business. In the 2 seasons of Kharif and Rabi, the sales are higher compared to the other months. In terms of working capital, the business requires a longer working capital cycle, so it requires a larger amount in terms of working capital. This industry is highly regulated by the government, so that always is a risk that the government is constantly monitoring your business and participating or intervening in the pricing of your products. The energy cost will impact the margins of this business. As we were listening to the earnings call, the management was mentioning that the coal prices have increased and almost doubled, which is impacting their margins right now. And due to availability of raw materials also, sometimes the company is receiving orders, but they are not able to manufacture and fulfill their orders because of non-availability of raw material, which is also a big risk for this company. Now, after understanding the business in detail, let's talk about the numbers part. The last 5 years, the revenue has gone up from about 400 crores to about 584 crores. And in FY23, you've heard that the company is giving a guidance of 800 to 900 crores in terms of revenue, which is a very good number. In terms of EBITDA, it's kind of flattish. It's gone up from about 60 crores to about 80 crores in the last 5 years. EBITDA margin is again flattish, somewhere around 14 to 15%. Profit after tax has gone up from 40 crores to about 56 crores in FY22. The profit after tax margin is also kind of flattish, is somewhere around 9%. And in future, the company is expecting that the PAT margin can go up from 11 to 12%, and that can be sustainable. Share capital is 31 crores. The reserves are constantly growing as the company is making healthy profits every year. The borrowings are under control. The debt equity ratio is just 0.22. The trade payables are fair and constant, and there's no abnormal movement in trade payables. The company is doing capex, and the fixed assets are bound to increase. They have gone up from 175 crores in FY21 to 195 crores in FY22, which will further increase in the coming years as the company is regularly doing capex. Inventory is again in line with the revenue growth, so there's no abnormal movement in inventory. Inventory days, the industry as such requires a higher inventory days, so it's almost 3 months for this industry. The trade receivables are somewhere around 100 crores on the balance sheet, which are also quite normal, and the debtor days have reduced from about 80 days to 60 days, which is a good sign. The cash equivalents are about 13 crores on the balance sheet. The operating cash flow was negative in FY28, but from thereafter it has always been healthy and positive, and it has done about 42 crores of operating cash flows in FY22. The free cash flows are sometimes negative because the company, whenever they are doing capex in any particular year, the free cash flow is becoming negative, as you can see in FY22, where the operating cash flows were positive. The ROCE is slightly reduced from about 22% in FY18 to 17% in FY22. This is one reason on account of the capex done by the company. This can be further improved as the capacities are being used in the coming years. Now let's talk about the shareholding of the company. The promoters hold about 68.5% in the company and public holds about 29%. There is very less holding from the FIIs and DIIs, only 1.2 and 1.3%. One thing interesting to note, as the promoters have slightly increased their holdings over a period of time. In Q1 FY21, they were holding 65.28, which is gradually increased to about 68.42% in Q1 FY23, which is a good sign. Now let's talk about the competitors of this company and compare them with the valuations of Shree Pushkar. So Shree Pushkar as a company does a revenue of about 584 crores and EBITDA of about 14%, ROC 17, PE 14. Market cap to sales is just about 1.3x, PB ratio 1.9. And the median P in the last 3 years has been 13. So looking at these numbers, you may feel that the valuations are quite cheap, but you should understand that because of the cyclicality in this industry has been given comparatively lower valuations when compared to the other industries. So if you see the other competitors of this company also, even if their ratios are slightly better, they are available at similar valuations as Shree Pushkar. Looking at Khaitan Chemicals and Fertilizers, revenue about 800 crores, EBITDA 15, ROC 36% and PE at just 10. So you can see it's generating a higher EBITDA and higher ROC compared to Shree Pushkar. Market cap to sales is just 1x. And PB ratio is 3.4 and median PE is again 10. Rama Phosphates has done a revenue of about 800 crores, EBITDA 12%, ROC as high as 38%. PE is at 7 and market cap to sales at 0.5 and PB at 1.8. Madhya Bharat Agro Products Limited, revenue at 500 crores, EBITDA 22%, ROC 30%, PE 25, market cap to sales 3x. So broadly, I'm just giving you some examples to make you understand that we can't just conclude looking at these companies that the valuations are cheap. As a sector, the sector has been getting lower valuation. The stat auditors of the company are SK Patodia and Company. In the related party transactions, there are no suspicious transactions. ROE is about 15% and dividend yield is about 0.4%. Now look at the chart. As we have discussed, the business is cyclical in nature, so is the chart. You can see that the stock made a high, then fell, and now it's again near its all-time high. So buying this kind of stocks at the fag end of their journey where the stock is making a high could be very risky, because if it goes into a down cycle, you will be stuck for about 2-3 years to recover back. So it's always better to wait and watch and let the stock fall and consolidate, and when it begins turning up, you enter. Or if you want to participate in the journey right from the beginning, the prudent strategy would be that you gradually accumulate, as the company has done good amount of capex and they have good expansion plans. So if you want to participate early, you cannot go all in these kind of stocks at once. You have to gradually accumulate the stocks on major dips. So in terms of valuation, the stock as of now looks fully priced, and when the future performance comes, the valuation becomes much cheaper, and if the cycle of the industry continues to hold in the upward direction, then you can see further upside. Otherwise, there is a possibility that the stock may enter into further downside and consolidation range now. So this is about Shree Pushkar. To summarize, let's discuss the thesis and antithesis points of investment in this company. The company has done a lot of growth capex, so there will be huge amount of revenue and profits flowing in. Compared to the earlier years, the company is forward and backward integrated, and it's a zero waste company. They use their own waste to produce the other products. The company has done some very key acquisitions and turned around those companies and made them profitable and scalable ventures. In terms of fundamentals, the company's fundamentals are good and it's at a good liquidity position. In terms of antithesis points, you should remember that in this industry itself is cyclical. So you have to have a good entry and exit point if you are investing in these kind of industries. It is a highly regulated industry dependent on imports for its raw materials. There is a huge There's a tough competition from other companies also in this industry, and in terms of valuation, the industry has been given lower valuation compared to the other industries. So before you invest, keep all these points in mind and then decide the valuation and entry points in these kind of companies. And it's also important that you time your exit in these kind of companies and industry. So this is about Sri Pushkar. I hope you like the analysis. If you like it, hit the like button and share the video with your friends. You want me to make videos on your favorite companies? Do leave the name of the company in the comments below. So thank you for watching and have a wonderful day.